Also in Washington, the House this evening passed a measure that some call the largest rollback of Wall Street regulations since the financial crisis. The legislation is designed to ease restrictions on small and medium-sized lenders. The Senate has already passed this bill, so it is entirely possible it could be signed into law as early as this week.
So what impact might that legislation have on the regional banks? Joining us to offer his insight is Ed Groshans. He's the Height Capital Markets Senior Bank Analyst. Welcome, Ed. Nice to have you here.
Thank you for having me on.
Do you expect this rollback to basically lift all boats in the regional banking sector?
I certainly do. I think this is a big benefit for all the banks in that $50 billion to $250 billion range. A lot of these heavy regulations that were made for global international banks will be dialed back and give management teams more freedom to handle their capital allocations.
So the restrictions, these are coming out of Dodd-Frank. You feel that perhaps they were overly restrictive, that they kept these banks from being able to do their business and make more loans? Is that the idea?
So all the banks are subject to annual stress tests, and at least all the banks over $50 billion. And to do that, you had to make sure that you didn't fall below the capital minimums. So all these banks held on to this excess capital, which they really didn't need. Once they become de-designated, they will not have to hold that excess capital. They could return it via buybacks, they could return it via increased dividends, or they could use it to grow their balance sheet and make more loans.
Are there any risks to rolling this back, to rolling back those restrictions on the regional banks and the mid-sized banks?
From my perspective, there are limited risks to doing that. It could drive some excess risk-taking, but even former Governor Tarullo acknowledged that $50 billion was too low of a threshold and it needed to be raised.
All right. So, I'm sorry, you said that this will basically lift all boats, but how about some highlights here, the companies that you feel will benefit the most from the lifting of these capital requirements?
Sure. So immediately, banks like Comerica and Zions Bank Corporation, they would be de-designated, so they wouldn't be systemically important as soon as it's signed into law. And they would then be allowed to manage their capital the way they wanted to. They still need to meet stress tests, but they don't need to meet the CCAR stress test, which is the onerous one. And then as we go down the line, 18 months down the line, you would see American Express, Huntington Bank shares, Fifth Third, and a number of other banks also have more freedom with their capital and how to allocate it amongst their balance sheet, their shareholders, the things that they think are important, not the things that the Fed think is important.
How much time do you think it will take for the trickle-down effects of these regulations being lifted to impact the bottom line of the banks? And therefore, as an investor, do you add those to your portfolio now in anticipation of that trickle-down coming sooner rather than later?
That's a good question. I mean, the financial sector was the biggest recipient of the breaks from tax reform. So everything else we're going to have down the line is going to be incremental. But we're in a very good environment. The economy is growing. Interest rates are going up. There's room to do lending. Now we have capital freedom. I think, when you're looking at financials broadly, I would be overweight the sector and certainly looking at the regional bank space.
All right. On that note, Ed, thanks so much. Ed Groshans with Height Capital Markets.